Is it finally time to sell stocks? Markets don't ring a bell at the top, but sometimes they flash an amber light bright enough that disciplined investors should at least pause, review risk, and trim exposure with intention. Today, several of the most reliable long-term valuation signals are in territory historically associated with turning points, not just elevated but extreme. The Shiller-Cape ratio is hovering near 40, a level reached only around peaks such as 1929 and the dot-com bubble. The Buffett indicator has surpassed 200%, meaning U.S. equities are valued at more than twice the entire output of the U.S. economy. Across price to sales, forward PE, and market concentration measures, the message is consistent. Markets are priced not just for growth, but for perfection, and perfection is where risk lives. Yet valuations alone are not the signal to act. Markets can remain expensive longer than logic suggests. The bigger concern is what's happening beneath the surface. Leadership is cracking. For years, a small handful of stocks carried the weight of the entire index. AI infrastructure, hyperscale cloud, and enterprise data were the dominant narrative, unstoppable and immune to volatility. That narrative is now wobbling. Palantir's momentum has stalled. Oracle has broken trend off recent highs. NVIDIA, the pillar of the AI rally, is showing its first real structural vulnerability. When the generals retreat, the rest of the market eventually follows. This is how regime changes begin, not with panic, but with the quiet deterioration of leadership. Importantly, this is not a doomsday forecast. It's a simple recalibration of odds. At current levels, the market is offering asymmetry in reverse. Upside is compressed by valuation. Downside is wide open if sentiment shifts. Consensus narratives are fully priced and concentration risk sits at historic highs. Leverage and optionality underpin the bid. Investors are not being compensated for the level of risk they are underwriting. This is the moment where strategy matters more than conviction. Selling stocks does not mean abandoning markets. It means changing posture from maximum offense to measured risk management. It may mean trimming winners instead of round tripping them, rotating from narrative to value and cash flow discipline, building liquidity for future dislocations, prioritizing resilience over participation trophies, owning fewer assumptions and more optionality. The most expensive mistake investors make isn't selling too soon. It's holding a thesis long after the risk-reward equation has inverted. The question today isn't, how high can this go? It's, do I want to own this much risk if it doesn't? In investing, humility beats heroics, risk management beats narratives, and capital preservation beats explanation after the fact. We may not know when the cycle resets, but we can see when the odds shift, and they just did.